Undersecretary Lang, when did you become aware of the severe financial distress of Silicon Valley Bank?
Aware of issues at Silicon Valley Bank on Wednesday or Thursday.
Vice Chair Barr, when did you become aware?
Thursday morning, I received an email from staff indicating that Wednesday evening the bank had difficulty.
Thursday morning. When did you become aware, Vice Chairman?
I believe it was Thursday evening. Staff came in to a meeting I was taking
Thursday
part
evening
in.
for Silicon Valley Bank. Okay. Along those lines, and you had a staff presentation in February that included Silicon Valley Bank and the distress because of rising interest rates on their portfolio. What did you do between that February staff presentation to you and the week of March 6th about Silicon Valley Bank?
Staff indicated that they were completing their review of the bank and of this broader horizontal review at that time, and I was waiting for the results of that review.
Were you aware of Silicon Valley Bank raising capital the week of March 6th?
I believe I became aware of that in this email that I described to you.
On Thursday morning, that they had successfully raised the capital, but they were facing financial distress.
I was not aware Thursday morning that there were deposit outflows. I was trying to finish the answer to that question. I was aware of the difficulty Wednesday night in raising capital, but the bank was reporting to supervisors Thursday morning that deposits were stable.
When did you become aware of the deposit flows on Thursday?
Thursday afternoon, late afternoon, I became aware of deposit flows, and Thursday evening that there was essentially a bank run.
So Thursday afternoon, which could be mid-morning in California? Is that what you're suggesting?
I believe it was around noon in California, and for me, around 3 o'clock in.
Okay.
On the
And did you make provision for the discount window or pledgeable assets at that time you heard of their distress?
My understanding from the staff is they were in discussions with the bank itself beginning Thursday afternoon to try and move pledgeable collateral over to the discount window. That work continued Thursday afternoon, Thursday evening, and actually overnight.
Did you make provision to keep the discount window open so they could provision collateral to avoid a bank collapse?
The discount window opening decision is sort of like a standard thing. It normally closes.
A standard
at 7
thing,
p.m.
except in a moment of crisis. It can be kept open. I think the vice chair for supervision should be able to make that phone call. Did you provision for that? Or did you think you needed a provision for that?
Mr. Chairman, at the time, my understanding was that the difficulty wasn't sending funds. The difficulty was actually getting the collateral, evaluating the collateral, and getting it pledged to the discount window. And staff were working with Silicon Valley Bank basically all afternoon and evening and through the morning the next day to pledge as much collateral as humanly possible to the discount.
So on Friday morning, Vice Chair, Chair Grunberg, you were appointed receiver. When did you become aware that FDIC was going to have to take this measure or was going to receive this bank?
I think when we were informed Thursday evening.
I mean you. Were you informed Thursday
I was
evening?
informed Thursday evening by staff.
Which meant you had Friday morning conference calls to make a decision. Was that part of it?
I think we were, I think we knew Thursday evening that the bank was going to fail and that we needed to make provision to take over the institution.
Did you pick up the phone and call the vice chair of supervision at the Fed and say, how can we provision to keep this institution open for a Friday?
I can't recall that. My recollection is, Mr. Chairman, that the institution was experiencing a liquidity failure and that it was going to fail. And
It was going to fail on Friday open or Friday evening? Were you provisioning for this for the weekend decision?
No, I think the expectation and their experience was that the institution was going to be closed in the morning.
At what point did you open an auction for Silicon Valley Bank? On Friday?
I believe it was Sunday afternoon.
Chair Grunberg and Vice Chair Barr, were a handful of large venture capital depositors able to influence the withdrawal of $42 billion all at once through their control over their portfolio companies?
Congresswoman, I think that is something we'll need to look at in terms of the post-failure review of these institutions. I couldn't tell you today, with certainty what occurred there. I know both the Fed in regard to SVB and we in regard to Signature are going to do a careful careful review of the events that occurred.
Thank you very much. Going further, Vice Chair Barr, what was the bank's rating on liquidity?
My understanding is in the summer of 2022, although the composite rating was a 3, that is not well managed, the liquidity rating was a 2, which would have been satisfactory. And one of the things we're looking at in the review is how that synced up with the supervisory matters requiring attention and matters requiring immediate attention with respect to liquidity that had previously been issued. So we're looking at whether those standards were sufficiently stringent, whether the firm should have been downgraded further, and whether further supervisory steps should have been taken.
Whose responsibility was it, understanding the deficient rating, to do something?
The Federal Reserve is responsible for supervising this institution.
Did the Federal Reserve fail on that?
I think that anytime you have a bank failure like this, bank management clearly failed, supervisors failed, and our regulatory system failed. So we're looking at all of that.
Thank you. Vice Chair Barr, you said yesterday that SVB received a 3 for its management rating, and you just responded in a way that says, yes, that is true, and perhaps something should have been done, and you're going to look further at that. Are you suggesting perhaps legislation to deal with that?
We're focusing in our review on our own supervision, ways that we could have done better as supervisors at the Federal Reserve, and ways that our own regulatory structure might have played a role with respect to the failure of this firm. So we're inward looking. It's a self-assessment, a prudent thing, I think, for us to do. It's what we tell banks to do. It's sort of the first thing you have to do to understand risk within your own institution, and that's why we're doing it.
Are there ways we can make the supervisory process more transparent to promote discipline and accountability?
I think one of the things we're trying to do here today is to provide that accountability, and we'll do that in our report, which we'll do on May 1st. It will include confidential supervisory information. We normally do not provide that information, but given the fact that this bank failed and triggered a systemic risk exception, we're including that information, including exam reports.
Chair Gruenberg, will Citizens Bank and Trust continue implementation of the former bank's community benefits plan?
The agreement between the community organizations in Silicon Valley in regard to the community benefits agreement was an agreement between those two parties. First Citizens will now be taking over Silicon Valley. There'll be an opportunity for the community organizations to engage with First Citizens. I know First Citizens has a community benefits agreement with community organizations where it's currently doing business. So there'll be an opportunity for the groups in California to engage with Citizens. And I would note Citizens is also subject to supervision under the Community Reinvestment Act. And so we'll be able to evaluate the degree to which Citizens is serving its communities pursuant to CRA.
Mr. Barr, when were you nominated for your job?
It was the spring of last year.
And do you know when you were confirmed for your job?
Yes, I took my post up in July of last year, July 2022.
July of 2022. So between January 20th, 2021 and July of 2022, who was in charge as Vice Chairman of Supervision at the Federal Reserve?
There was no vice chairman for supervision during that time period.
And so when that happens, what's the Fed's process for delegating that authority to another member of the Board of Governors or a staffer, or how's that work?
I apologize. I don't know the technical answer to that question. We'll have to get back to you with a written
Yeah,
response.
if you get back. And then the downgrades didn't come, and those tough visits didn't come till the summer of 2022. So really 12 months of discussion between the board and the state of California and the San Francisco Fed. That doesn't sound like a very urgent supervisory process. What is it? Do you consider that urgent to take a full 12 months in that process?
Mr. Hill, I think you raise an absolutely essential question. It's one of the things we're going to be asking in our review. Obviously, these events occurred before I arrived at the board. I'm going back and looking at what steps were taken and not taken. And I think it's a completely fair question. Should the supervisors really, been much more aggressive in the way that they responded to the risks that they saw and they were noting, and we're gonna look carefully at that.
Yeah.
I think it's
The 12 USC 1818 on cease and desist, where the FDIC, The primary bank regulator, the state, can do whatever they want to a bank that's not operating in a safe and sound manner. Isn't that right, Mr. Barr?
The bank regulators have substantial discretion to use those authorities
Right.
when banks are operating in an unsafe and unsound manner. I agree with that.
And I thought Senator Crapo's comment yesterday was very, very important, that in the rule of construction, that final bit of information in S-2155, the bipartisan bill, bicameral bill signed by President Trump, it says nothing in this bill shall be construed to limit the supervisory authorities for safety and soundness in any way. Isn't that what that rule of construction says?
Yes, I agree with that. I think we have substantial authority under existing law to regulate firms and supervise firms in a way that is appropriate for their risk and size and complexity.
Thank you very much. Mr. Chairman, talking about the resolution process, are you open to a full investigation, not only of the deposit insurance and not only of the supervisory process, but also look carefully at the resolution process itself?
Yes, Congressman.
And are you going to conduct that yourself, or would you work with us on that?
Well, we would certainly be prepared to undertake that review and be transparent with you in regard to it.
Something I want to see considered, and I argued this back in 2008 as a private citizen and banker, which is in the resolution process to consider non-bank buyers for these assets. Do you agree that's important? We should consider that?
Yes, it is, Congressman.
Mr. Barr, don't you think Category 3 and 4 banks should face the same rules as the mega banks?
We are looking at capital and liquidity standards for all large banks, including firms 100 billion and above. I still think a tiering approach makes some sense. It doesn't have to be the same rules for all banks, but we do need stronger rules for firms of this size. Stronger rules on capital and liquidity, I think, are going to be really important.
Under our current capital rules, most banks are not required to recognize this risk, only GSIBs. Will the Fed rewrite its rule to require all banks to account for interest rate risk?
Well, you raise an absolutely essential point, and one that we are very carefully looking at. We anticipate engaging in a notice and comment rulemaking process on capital rules with appropriate transitions, and that is one of the areas that I think would be important for us to consider in that rulemaking process.
So do you think that the rules passed under S-2155 and written by the Trump administration need to be rewritten?
We're going to look as part of our review at not only our supervisory issues, but also at the regulatory structure that the Federal Reserve put in place in 2019. And see whether the size thresholds we used, the standards we decided to put in place, all of that is on the table. We're reviewing that. We're going to come back and provide an assessment of that on May 1st.
Can you explain how the Fed's bank supervision staff coordinate with its monetary policy-focused staff to ensure that banks are properly prepared for well-telegraphed shifts in monetary policy? Does the Fed see regulation and supervision as separate from monetary policy?
The whole of the Federal Reserve staff communicate very well together. As you noted, the monetary policy decisions were very well telegraphed. The decisions were essential to meet our congressional mandate of price stability and maximum employment. And we need to make sure that we continue to pursue that. We have separate tools that we use, of course, and as I said in other contexts, interest rate risk management is a core bread and butter issue in banking. It's not an esoteric issue, an exotic issue, a complicated issue. It's a straightforward issue, and the bank management failed to do that here.
How will the Fed balance its supervisory role with its monetary policy role as it considers future interest rate increase?
We have really all the tools that we need on the macroprudential and microprudential side to assess financial stability and bank safety issues. And as I said, the banking system overall is sound and resilient. Deposits are safe. On the monetary policy side, we're going to be looking at incoming data. We're going to be looking at changing financial conditions, and we'll really make a judgment on a meeting-by-meeting basis about that decision.
Give me some inward thinking, because I heard no one say, we were part of the problem. We need to look at us being part of the problem and we need to be a part of the solution. Mr. Barr?
I agree with you. I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that. And I think we are going to be unflinching in our review about that.
Does that
So-
include your role?
Absolutely. Absolutely. And I'm here today to be accountable to you for that purpose.
Chairman?
Congressman, I really don't mean to shirk responsibility here. I think we share responsibility. I think bank management had responsibility. I think we, as the regulators of the institution, had responsibility. I think we're going to conduct reviews to get the facts as to what occurred and a measure of internal as well as external accountability. My own sense here, in terms of the supervision of these institutions, from my perspective, is that both agencies, and I would include ourselves, were aware that there were issues at these institutions and trying to address them through the supervisory process. It's also my judgment, I think, and we're going to conduct a review to get all the facts here, if I may say.
The gentleman can answer the rest for the record.
Are there any banks out there, and roughly how many, that have capital of under 5% if you subtract from their stated capital their unhedged, unrealized losses on long-term debt?
Congressman, that's a fair question and a factual question. If I may, let us get back to you on that. We'll get the numbers and share them with you very quickly.
And please don't give me the names. Mr. Barr, do you have any other answer?
No, sir.
My question is, does the Fed, before it raises rates or lowers rates, does it have an economic study done by its economists? They've got a team of economists there. Do you have an economic analysis done of the impact of that? Mr. Gabarino, would you please move to your right, please? Thank you.
Yes, we evaluate all the economic conditions.
Do you get a report
and
from your
financial
economists
conditions
that the
when
Fed-
making any interest rate
That the
decision.
Fed, does the Fed board get a report from their economists saying what the impact of their rates will be on the economy? Yes or no?
Yes, we get staff forecasts that forecast the expected impact on the economy of rate decisions.
Okay, how come you made a specific mention that of this in your February report then? Why did you specify that you got the rate?
That's what I was trying to explain earlier. I mentioned that because the report specifically called out Silicon Valley Bank. We regularly discuss interest rate problems.
Okay.
Interest rate risk is an important part of supervision and a
Great.
bread and butter issue.
Okay, a bank this size, normally you'll have an examiner or two or a team that is in there on a daily basis. Was there an examiner or team of examiners in Silicon Valley Bank on a daily basis?
The team consisted of about 20 full-time equivalent staff at the San Francisco Federal Reserve Bank.
They were not in Silicon Valley then?
I don't know precisely the extent of their in-person meetings versus their remote analytic work.
Why was no action requested or not forced on the bank?
There was action requested of the bank in the matters requiring attention and matters requiring immediate attention.
Why were they not enforced?
I think that's a question for our review. We don't know. I don't yet know the answer. Could the staff have escalated more? Should they more? What were the interactions with the bank? That's all part of the supervisory record that will be in the May 1st report.
For you to make the statement, we need more rules and regulations, how about enforcing the existing ones first?
We're going to be looking, as I said, at our own supervision under the existing framework, ways in which existing
Okay,
rules
very
might-
quickly, I've got one more quick question for you here. It begs the question down the road here, Mr. Barr. It opens up the possibility whenever you have a bunch of significantly distressed banks that there could be a short sale on some of these things that could be out there. We need to be talking about that. Are you thinking about that at all yet?
Yes, I think you're raising absolutely important and critical questions about the role of social media, the role of networks, depositors with each other, and the
And you're
potential.
working on a real-time payment system that's going to be
Gentleman's-
ripe for a problem like this with Twitter if we don't
Gentleman's
fix it
time's
beforehand.
expired.
Where did the Fed go wrong? And specifically, did the Fed miss red flags or ignore warning signs that were brought to you by your staff months or even years before the collapse?
We do have in the supervisory record staff reaching out to the bank, highlighting these problems, As you noted, in the first instance, it's bank management's responsibility to fix those problems. They didn't do so.
Well, Vice Chair, is it true that the San Francisco Fed, which supervised Silicon Valley Bank, sent multiple warnings to the bank's management about the risk it was taking, including its substantial holdings of treasuries and other bonds that were steadily losing money as interest rates rose?
Yes, the supervisors pointed out to the banks that they were exposed to interest rate risk and liquidity risk, and that they didn't have the risk management in place to address those.
And
The bank failed to fix those problems.
And how often did Fed staff share with the Board of Governors that rising interest rates were threatening the finances of some banks, and in particularly the risk-taking at Silicon Valley banks?
My understanding is that the particular issue with Silicon Valley Bank did not rise to the level of the board until mid-February of this year.
And the other question is
The
this.
Board of Governors, I should say.
Why do you think that the full extent of the bank's vulnerability did not become apparent until it was too late?
I think that one of the things we're looking at is that the way the Federal Reserve's regulations set up the structure for approach to supervision treated firms in the 50 to 100 billion range with lower levels of requirements, and had a phase-in period for firms that got above the 100 billion line. That meant that their transition into those higher standards took a long time. So by the time the group was actually looked at in an intense way by the group in the large and foreign banking organizations team, a lot of that growth and a lot of that activity had happened. And so, in a sense, it was very late in the process. And that's one of the things we're looking at in our review.
Good. And whether the Fed failed to properly oversee Silicon Valley Bank will take place, and more importantly, that it will be shared with us in the public. Is that true?
Yes, that's absolutely right. We thought that it's really important as a first principle of risk management for us to do our own self-assessment. We have a team of people working on that self-assessment who are not involved in the supervision of Silicon Valley Bank. We're going to make all of those findings and recommendations public on May 1st. And let me also say we welcome other outside reviews, as this body is doing today, and others will as well.
You were authorized, though, on March 13 to do your report, correct? Who authorized that?
Chair Powell and I made...
Okay, that's all I need to know. Chair Powell authorized you?
Chair Powell and I jointly made the decision
Okay.
for me to proceed
Great.
with this.
Is it your understanding as well that under Dodd-Frank, anytime 13.3 is invoked and utilized, that the GAO is also supposed to do a report?
I'm not familiar with that precise provision, but it makes sense to me that GAO should do a review.
Okay. And do you know when GAO is going to be starting their report?
I respect the
investigation?
independence of the GAO
Okay,
and would suggest
great.
that
Page 2 of your testimony, you said that the May report will include confidential supervisory information. Will you be providing that CSI to the GAO?
yes, consistent with
Okay.
normal practice.
Right? Well, we might have to unpack that a little bit. Will you also commit to me and this committee and to the chairman that you will provide this committee with all those same related confidential supervisory information needed to appropriately assess on our end what happened?
Yeah, the same information in the May 1st report will be available.
No, not in the report. You're giving if you're giving that supervisory information for the GAO to do their review, not before you review it yourself and decide what is appropriate and not appropriate. I thought you just said that you would be providing GAO with all of that data and information that you will be using to make your report. Is that correct?
We will make the information that we are using for the report available to you and to the GAO And
Okay, so we have your
the public.
commitment that you are going to be providing us with all of that raw, confidential, supervisory information so that we can do our job.
the same information that we'd use for the GAO and for the public report.
Ms. Lang, has FSOC met since March 24?
They have not met since March.
You have not, okay. So it was reported that Secretary Yellen convened these officials via video conference, is that correct?
Yes, I believe there
And you
were
were part of
two
that?
FSOC meetings.
Okay, and you were part of that?
I was part of the second one. I was not part of the first one.
You were not part of the 10th,
I
okay?
was not. That was the evening, I believe, we announced. I was not part of the March
All right.
12th meeting.
Were minutes taken at those meetings?
As by normal process, minutes would have been taken.
And will we have access to those minutes
Yes, they are released according to.
before they're released? Because we only have minutes from December 22. There is nothing that has been released publicly since December 22.
That is correct. I believe the process is minutes are released following the next formally scheduled FSOC meeting.
Only if
But
formally
we can-
scheduled.
We can come back to you on that, when they will be released.
So we have to wait till the next formally scheduled time to get those minutes.
I understand that's the process, but
We'll be
can come
following
back
up in writing. Thank you.
Mr. Grunberg, I need a commitment from you, sir, that you need to come to Brockton. You need to come to Brockton in my district, and we need to work this through so that we provide the kind of protection for low-income families, a lot of them families of color, many first, they're first-generation immigrants, and, they need help. And I think you and I need to be there, and I'll get my mayors together and these 18 affordable housing development managers, and we'll try to get this done. But can I get your commitment? Any thoughts on that?
Yeah, Congressman, I'd be glad to do that and follow up with you as First Citizens takes over, is in a position to continue to serve the customers of the former institution and work with you in regard to the community issues you just described.
Is there something more that we need to be doing now because of the velocity of money? People can move their money out like that, and are we equipped? The FDIC has a long and strong history, but is something new and different needed to protect us from that phenomenon?
Congressman, I think that's an important question to ask. I think we are dealing with a different environment, and the point you raise in terms of how quickly money can move, what the technology enables now that exceeds what's occurred in the past is a new risk factor that we have to think about.
Vice Chair Barr, referring specifically to Federal Reserve supervisors, do you know how many citations that were issued to Silicon Valley Bank regarding its management of liquidity risk?
In November 2021, there were 6 MRAs and MRIs on liquidity. In the fall of 2022, there was an additional MRA on interest rate risk modeling.
Yesterday, you were asked about an MRIA that was issued in the fall of 2022. You stated that the MRIA was issued, quote, based on the inaccuracies of their interest rate risk modeling. Essentially, the risk model was not aligned with reality. This is your quote.
Yes.
Did the supervisors provide the bank a timeline to remediate this misalignment?
Yes, my understanding that there were time limits associated with each of these MRAs and MRAs, but I don't have the information.
Really?
precisely
Okay, well,
the time.
clearly those alerts were ignored at the bank. Why didn't the Fed consider escalating any of these issues into a cease and desist order or other formal enforcement action against the bank to require senior management and the board of directors to remediate these serious deficiencies?
I think you raise a fair point, and we will be looking into that.
Was trading risk the reason SVB had almost 94% of its deposits uninsured?
No.
Was trading risk the reason SVB did not have a risk officer for nearly 9 months last year?
I do not believe that that was the focus of why there was not a credit
So,
risk officer.
no, trading risk was not the reason. Was trading risk the reason SVB had 51% of its deposits in the tech industry? Yes or no?
Not to my knowledge.
Can you show how trading risk directly resulted in SVB failure? Or, sir, are you just looking for any reason, correlated or not, to justify increasing capital requirements for our banks?
I think it's really quite important that we strengthen capital and liquidity requirements in the system. It's something I've been working on since arriving at the board in July. And I think that the work that we're going to do, that we will propose through notice and comment rulemaking, will make the financial system safer and sounder. That reduced risks that firms such as SVB in the future
You have stated
might cause
that yesterday that our banks are well capitalized, did you not?
Yes, I have been consisting in saying that both that the system is strong, but that also we need to think about stronger capital rules, and I think that's appropriate.
Mr. Gruenberg, is it true that hours before the takeover of the bank, before it was seized, that bonuses were accorded employees?
Congressman, since we weren't the supervisor, I wouldn't have that direct information. I'm sure we could get it for you, or the Federal Reserve could provide it.
I welcome the intelligence from the Federal Reserve.
But if I could just make an additional point, which is the FDIC is under a legal obligation after the failure of Silicon Valley to conduct an investigation of the conduct of the board and the management of the institution. And if misconduct occurred, we do have authority to impose civil penalties, including civil monetary penalties, restitution, and to bar individuals from the business of banking.
Thank
So
you.
we do have some significant authorities and responsibilities.
Thank you.
The board also has the authority.
Without the authority right now, just tell me, did the bonuses, were there bonuses given out hours before the bank was seized?
I have seen reporting of that, but I'm still trying to chase down the facts. Our enforcement team has the ability to go after actions against individuals.
So you're saying you do not know, but you have heard that this is the case?
Yes, I do not have the supervisory record of that to know, but I've seen reporting of that, and we're looking into it.
Do you have the inherent or accorded or statutory power to claw back those bonuses?
We have the ability to pursue actions for individuals who violated the law.
May I kindly ask about clawback of bonuses? Can you claw back those bonuses?
Under our authority, if there are violations of the law or unsafe or unsound practices or any breach of fiduciary duty, we can get restitution, we can get civil money penalties, and we can have a
should I
prohibition
assume
of
that your answer is no, you do not have the authority to claw back those bonuses?
We don't have generalized clawback authority.
You do not. All right, I see a hand raised. Mr. Gruenberg, please.
Just to try to respond directly to the question, we do not have explicit the FDIC does not have explicit clawback authority under the Federal Deposit Insurance Act. We have that authority under the Dodd-Frank Act in regard to failures under Title II, but we do not have that under the Federal Deposit Insurance Act. So in considering additional authorities that Congress might provide, that might be something worth considering.
Thank you. Vice Chairman Barr, true or false, Silicon Valley Bank experienced rapid asset growth in a short period of time?
Yes, that's correct.
Silicon Valley's rapid growth was fueled by an extremely high concentration of deposits from a single sector.
Yes, that's correct.
Silicon Valley Bank became overdependent on an extremely high percentage of uninsured deposits.
Yes, that's correct.
Silicon Valley Bank failed to hedge the risk of holding long-duration securities in a rising interest rate environment.
My understanding is at one point they had hedges, and those were not in place at the time they failed.
And that was apparent to the Fed.
Yes, it was apparent to the Federal Reserve.
Silicon Valley Bank had no chief risk officer for 8 months before its collapse.
Yes, that is correct.
Was the San Francisco Fed unaware of any of these basic facts in the months leading up to its failure on March 9th?
Not to my knowledge.
So nothing in the existing regulatory framework concealed these basic facts from the San Francisco Fed, which had responsibility of supervising this bank.
The regulatory structure doesn't conceal facts. It may have an effect on how supervisors act with respect to those facts.
True or false, Silicon Valley Bank was subject to enhanced prudential standards under Dodd-Frank as amended by the 2018 bipartisan regulatory relief law.
The Federal Reserve supervisory structure did not apply most enhanced prudential standards to the firm. It did have some enhanced prudential standards once it became subject to those standards after it passed the
Let's take
average at the 100 billion level.
before it passed that $200 billion threshold. When it passed the $100 billion threshold, it was under 2155, the bipartisan regulatory relief law, under Section 401A1C of that law. The Fed could have applied enhanced prudential standards to Silicon Valley Bank. Is that correct?
Under the 2019 rules that the Federal Reserve put in place, most enhanced prudential standards did not apply to the firm.
Well, wait a minute. I don't know about that, because under 401A1C of that law, the Fed, by order or rule, could apply enhanced prudential standards to banks not above $200 billion, but above $100 billion in assets on a one-off basis.
Yes, the legislation provided the Federal Reserve with ample discretion. The way that discretion was implemented in 2019 was with a rule, and that rule provided.
But in
some
order,
enhanced
but by
standards,
order, and reclaiming my time, Vice Chair, by order, the Fed could have applied enhanced prudential standards before the bank reached the size it did by February of 2023. Will you commit to using your authority under 12 U.S.C. 1817 to establish separate risk-based assessment systems for large and small members of the Deposit Insurance Fund so that these well-managed banks don't have to bail out Silicon Valley Bank?
Certainly willing to consider that, Congressman. And as I indicated, we are going to be preparing a comprehensive review of the deposit insurance system. So we'll come back to you and glad to engage with you.
Gentleman's time is
I'm
expired.
going to ask you for ideas, not necessarily good ideas. I understand that you're going to be uncomfortable to make recommendations, but clearly we need to tighten up the process by which good things happen after a finding of deficiency. So should that be left in your regulator's discretion, or should we act in such a way as to make actions mandatory subsequent to a deficiency rating?
It's a great question you raise, and one that I think is appropriate for reviewing both by you and by us. I think that we need to put in place risk mitigants and incentives that are much stronger, faster in the supervisory process. That's one of the things that we'll be looking at in the review. But I do think that in instances like this, where it is such a fundamental issue, we need to have risk mitigants in place that are ordered by the supervisors quickly.
Mr. Grunberg, you talked about it before, but could you elaborate if smaller community banks in Texas, where I'm from, will be left responsible for bailing out the failed banks in California and New York, which we don't even know where they are?
Thank you, Congressman. I'm keenly sensitive to the concern. Let me just say, under the law, the FDIC is required to impose a special assessment on the banking industry to recover any cost to the Deposit Insurance Fund from covering these uninsured deposits. And we have to do that by a notice and comment public rulemaking, which we're going to do in May. And just to be clear, the law gives the FDIC authority to consider the types of entities that benefit from any action taken or assistance provided, so that the FDIC does have discretion. And let me just say, without forecasting what our board is going to vote, we're going to be keenly sensitive to the impact on community banks.
Take the bar. What actions, if any, did the Federal Reserve take, and you talked a little bit about this, after issuing those risk findings, and how did the Fed Reserve become so complacent on its supervisory role and miss these warning signs? And I think that's what people across America really want to know.
Thank you very much for the question. My understanding is that the supervisors identified the issues, they brought them to management's attention. The response clearly was not an effective response. Bank managers failed to manage the firm in an appropriate way. They didn't manage their interest rate risk and their liquidity risk well, even though it was pointed out by the regulators. And I do think it calls for a heightened need for more aggressive supervisory action to take care of these problems.
But you all missed it too.
I'm sorry?
You missed it too.
The supervisor staff were aware of the underlying issues. I think all of us were caught incredibly off guard by the massive bank run that occurred when it did on March 9th and 10th. The scale and speed of that, $42 billion going out the door Thursday afternoon. It was expected by the bank that $100 billion more would go out the next day. That's just an extraordinary scale and speed of a run that not anything I had ever seen before.
Real quick, Mr. Barr, how can the American people trust the Federal Reserve if you are not testing for all scenarios? How was the Federal Reserve so far off? That is a question that everyone asks again.
I think that the Federal Reserve should use multiple scenarios. That's one of the reasons why I proposed that for this year's test. It includes a rising interest rate environment for the trading book. I think multiple scenarios makes a ton of sense and should be done.
Question is this, Vice Chair Barr, as part of your holistic review of bank capital requirements, will you commit to finally seriously considering contingent capital requirements in the capital stacks of large banks?
Both the FDIC and we have issued an advance notice of proposed rulemaking of a different type of contingent instrument, a gone concern capital instrument that would be required for large banks. But I think it does make sense to consider alternative options, and I'd be happy to continue the conversations with you about that.
Mr. Grunberg, will the FDIC sell off Signature's deposits from digital asset businesses? Yes or no?
We're returning those deposits to the depositors, Congressman.
So, okay. Does the FDIC plan to sell the intellectual property for Signet?
I believe that's already been sold out of the bridge institution, Congressman.
All right, we would like to see that information. Will you commit that a bank that buys Signet will be able to use it to facilitate 24/7 access to the banking system for digital asset companies?
I'm happy to look into that. I don't know who the buyer was, but be glad to look into it and follow up with you in regard.
You're not going to block the buyer from doing 24/7 banking for digital asset companies, is that correct?
If that's the nature of the acquisition, yes.
And will you commit that a bank that buys Signet, or the bank that did, will be able to onboard new digital asset customers?
Again, I'd like to look into the transaction, but I'd be glad to follow up with you in regard to it.
When the FDIC sold off Silicon Valley Bank's deposits to First Citizens, did that include deposits from any digital asset firms or VCs in the digital asset space?
I believe all of the deposits from the failed Silicon Valley Bank were transferred to First Citizens in
including the digital.
All of them, yes.
Were all of SVB's deposits from digital asset businesses, again, transferred to Citizens? That's what you're saying?
My understanding, First Citizens assumed all the deposits of the failed.
Has the FDIC ever communicated implicitly or explicitly, sir, to any banks that their supervision will be more onerous in any way if they take on new or maintain existing digital asset clients?
No.
Can you share with us or explain to us what the typical ratio is for your average bank and how this factor played into the bank run that we witnessed on March 9th?
Thank you, Congresswoman. It's an important question. I think fair to say these two institutions were outliers in terms of their exceptional concentration of uninsured deposits, both around 90%. In the regional bank space, between 100 and 5 or 600 billion, I think it's generally in the 40% category. So these two institutions were outliers, and it was a significant part of the liquidity risk on their balance sheets.
And would you say that this high proportion of uninsured deposits left the bank more susceptible to this run?
Yes, it was, I think.
What about temporarily insuring all deposits, increasing a limit to 500,000 or $1 million, insuring all deposits for small and mid-sized firms, or limiting it for the largest financial institutions? What are your thoughts on some of these proposals?
Well, as you understand, Congresswoman, the coverage for deposit insurance is statutorily set at $250,000 per account. So to adjust it would require legislative change. And as I indicated earlier, the FDIC is undertaking a comprehensive review of our deposit insurance system, and we'll come back with a report that we'll release publicly outlining policy considerations for.
So is this one of them? And you can weigh in also, Mr. Barr or Ms. Lang, on, I mean, you're experts, you're testifying here on your opinion.
I look forward, the FDIC, as Chairman Gruenberg mentioned, is doing a review of the deposit
Would you
insurance
support
fund.
an increase?
I would support a study and proposals for reform if needed. The rise in uninsured deposits, it has been increasing over the years.
Okay, only because my time is running out. Mr. Barr, and the next question is going to be for you, so.
We'd be happy to work with you on thinking through that. I think taking a step back, the important thing is that our banking system is sound and resilient.
Okay.
The actions the regulators took demonstrate that deposits are safe, and we'd love to continue the conversation with you.
Can you tell me how it's possible when this special assessment fee process is completed that my community bankers aren't going to wind up disproportionately paying for the mistakes and the falderall of the biggest institutions in the country? Or are they just be prepared to be the goat one more time?
Critically important question, Congressman, keenly sensitive to it. We have discretion under the law. We have to act pursuant to a notice and comment rulemaking. Anything we put out will be subject to public comment, but we have discretion, as I indicated earlier, and will repeat, we'll be keenly sensitive to the impact on community. I don't want to front run my board. We're going to have to do a notice and comment rulemaking, but I hear you and keenly sensitive to the point you raised.
I would just, Vice Chair Barr, could you provide insight into which regulator acted first in proposing that uninsured deposits be protected? And were there discussions between the FDIC and Fed prior to the respective board meetings? Please, thank you.
We were in conversations, all three agencies, over the course of that weekend, trying to think through what the potential ramifications might be in the financial system. It was a very difficult judgment to make. It involves, of course, information we're getting from around the system, from hearing from community bankers.
If the gentleman, if
You, Mr. Barr, you were quoted quite extensively for saying SVB's failure is a textbook case of mismanagement. Was that a correct quote?
Yes.
Well, then why, the natural question is, to begin, why wasn't there a textbook case of enforcement?
I think that's a good question, one we're exploring very much. The supervisors looking at the bank identified the problems with the bank. And the question is, did they identify them with enough level of urgency? Did they escalate appropriately? And I think that's what is an incredibly fair question we're looking at carefully. I expect that we're going to find that we need to have more of an emphasis on supervisors using the tools they have more promptly and putting in mitigants in place more promptly when they see problems at banks that they're supervising.
Yeah, in fact, they had a number of MRAs, MRIAs, I guess, and it didn't seem like you did anything other than write a letter. I mean, it didn't seem like there was any enforcement. I mean, where was the stick?
Yes, I think that's exactly the right question. Normally, in the supervisory process, when a supervisor issues an MRA or an MRIA, the bank promptly takes care of those matters. In this case, obviously, it didn't take care of them in such a way that it prevented its
It seems like they blew you off. I mean, it seems like they blew you guys off and you didn't do anything. I mean, that's what it seems like for reading all this information. I can tell you, maybe I'm wrong, but that's what it sounds like.
Yeah, I think that, again, we're looking at the whole supervisory record. I share your concern very much. I think it's something we're going to have to explore both in terms of the way the bank responded and the bank's responsibility for its failure, but also should regulators have used tools to escalate more promptly and quickly? I think that's a completely fair question.
Okay. Chairman Bloomberg, in your hearing before the Senate Banking Committee, you testified that the collapse of SVB and Signature Bank demonstrate the implications that banks with assets over $100 billion can have financial stability issues. I think that's what you were quoted. Additionally, you stated that the prudential regulation of these institutions merits serious attention, particularly for capital liquidity and interest rates hike. Can you please elaborate more about what prudential regulations need to be reviewed? What steps can we take to mitigate the potential for similar bank failures?
Thank you, Congressman. Look, I think we should start with supervision and how we supervise liquidity risk. And two big things in this episode was liquidity risk from concentration of uninsured deposits and the accumulation of unrealized losses on the balance sheets of our institutions, both of which go to fundamental management of interest rate risk, which is...
Right, but the size, I'm talking about the size of the bank. I think that's significant.
And I think it applies to all institutions. I think in the past, we've looked at these regional banks and smaller regional banks, and in terms of their prudential regulation, have treated them somewhat more lightly than the larger institutions.
My time is
in light of this episode, we need to take a close look at that.
Thank you.
That was the point I was trying to make.
Undersecretary Lang, I wanted to get a little clarity on what seems like is conflicting accounts from Secretary Yellen regarding deposit insurance. Could you clarify the Department of Treasury's position regarding deposit insurance?
Yes, thank you, Congressman. As Secretary Yellen has said, we have used tools to prevent contagion in the banking system and have reflected a commitment to ensure that all deposits are safe. And that means we would use the tools again, if needed, to ensure that Americans' deposits are safe.
So your answer is yes, you would include smaller institutions, smaller banks, community banks, or, I mean, I'm a little confused.
If conditions warranted, deposits that smaller institutions could pose a risk of contagion to the broader system, we would absolutely use the tools.
So I guess the question would be then, what is that condition? If it starts with one community bank, then that would be a trigger, or do you have more definition of what would be the condition?
I think it's very difficult to just make decisions on the hypothetical, but in this environment that we made the systemic risk determinations based on unanimous approvals from the FDIC and the Fed, we determined that the risk of contagion in the banking system was very high.
Do you have concerns that regulators may be creating moral hazard across the entire banking system?
I think we are concerned with addressing the current situation that we are facing. We think the system has stabilized. We have information and evidence that deposits have stabilized. We will need to address reforms going forward to address concerns about moral hazard.
Why did the Secretary's position appear to change regarding the extending insurance to various, or to smaller institutions? Why did she change her position between the 21st and 23rd? Were there internal discussions going on between the Secretary and the President or other prudential regulators that caused the shift?
I'm not aware of any conversations.
Okay.
Given the prior concerns from the Fed, did the Fed participate in or otherwise have visibility into any of those risk meetings at SVB in that window?
I don't have yet the full supervisory record, so I'm not able to answer the question, but we will have that information in the May 1st.
Okay. Do you know if they were at any time cited for violating Section 165 of Dodd-Frank that requires banks over $50 billion to have a risk officer for the 9-month period when they did not?
The deficiency downgrade that occurred in the summer of 2022 focused on a wide range of risk management practices at the firm and found them to be deficient.
Okay. Was it perceived by the Fed or by management that they were in an improved risk situation at the end of 2023 than they were 3 months earlier?
I don't know the answer to the question with respect to how the management of the firm were viewing the situation. The supervisors were telling the firm at that time that basically their risk models were divorced from reality, that the models suggested they'd earn more money when they were losing more money.
Okay. Do you have any visibility, when was the security sale and/or the equity sale to Goldman process initiated? In other words, not when was it announced? When internally was the company initiating the process to secure additional cash from those two Goldman processes?
I do not know the answer to that question.
I imagine you probably also don't know whether the January 26 sale was cleared with their risk officer, who had been on board for 3 weeks when the January 26th announcement was.
I don't yet have full visibility into that transaction. I hope that we'll be able to get as much detail as we can as part of our review.
Was there any outreach to the depositors during this period to ask them either to provide equity infusions to the bank or other forms of capital prior to the run of the bank?
I do not know.
Last question, in the exchange with Mr. Scott, you had indicated that and I think I got this right, that the Board of Governors' concerns about SVB were really heightened in mid-February?
What I said is that the staff presented to the Federal Reserve Board of Governors in mid-February on interest rate risk generally, and one of the firms they highlighted as having interest rate risk was Silicon Valley Bank. And the staff indicated that they were doing a further horizontal review and would come back with further results of that review.
Okay, so is it your position that the trigger for the heightened security was simply interest rate movement, or was it anything else about this calendar that triggered that heightened concern?
I didn't describe it as heightened concern. Basically, the staff were presenting on interest rate broadly, and the firm they singled out as having interest rate risk was Silicon Valley Bank, and they discussed the horizontal review they were doing and the fact they'd come back with further information after that horizontal review.
Chair Grunberg, why did the FDIC cap its potential gain on First Citizens stock at $500 million?
I think it was a negotiation, Congressman, and that's what we were able to work out.
And so why not allow the federal government to recoup more of its losses? Why not and share in this outsized gain at First Citizens?
I wouldn't argue with that, but we had a negotiation with the acquiring institution, and that's what we came out with.
Okay. You think you had good negotiators at the table?
Maybe we could have been better, I don't know.
Okay. And Chair Grunberg, did you receive any pressure from the White House or other elected officials not to allow for consolidation of large or mid-sized banks with Silicon Valley Bank as part of the review process of potential bidders?
No, Congressman.
Vice Chair Barr, can you tell us whether or not the Fed was also conducting its examinations remotely or on-site and in person?
My understanding is that there's a mix of activities. I don't know how much was on-site. A lot of activity occurs remotely, doing analytical work and so on, but I don't have a precise answer to that question.
Under Secretary Liang, earlier my colleague, Mr. Loudermilk, was questioning you about some of the comments of Secretary Yellen. Can you clear that up for me, and am I mishearing what you and the Secretary are saying?
Yes, Congressman. The point that we've been making is that we would use the systemic risk exception or our and tools to prevent contagion in the broader system if a bank were to fail. And that could be a bank of different sizes, and it would be designed to keep all American depositors safe.
Do you have confidence in Secretary Yellen at this stage?
Absolutely.
Under Secretary Lang, do you think social media and online banking tools have the potential to increase the intensity of future runs? And if so, what do you think the appropriate response from Treasury, Congress, and regulators should be?
Congressman, I do agree that the runs that occurred at Silicon Valley were unprecedented in speed and size, aided by social media technology. Those are new risks that challenge the banking system and the financial system, and are those that we'll definitely need to be considering and working with Congress on those issues.
So you're working on that?
Yes, we've been working on how to think about the payment system, how to think about fintech and digital assets, and this has now also become apparent.
Thanks, I'd like to work with you on. Vice Chair Barr, do you agree with comments made by Secretary Yellen that supervision is critical to identifying the failures of bank management? And there was clearly there was a huge hole in Fed supervision of SVB. Can you talk about that a little bit, please?
I think supervision and regulation both play an important role in overseeing bank management. And obviously, in the first instance and in the last instance, it's bank management that's responsible for running the bank. And in this case, it did it in a way that caused its failure. We are taking a careful look at the role of supervision and regulation and not forcing managers to do a better job in running their own bank.
When exactly does the Fed give these supervisory reviews some more muscle and step in to prevent disaster? And can you talk a little bit more about what happened here and what you're trying to learn? Thanks.
Thank you. A great series of questions. You know, the Federal Reserve's system of supervision and regulation is based on a tailored approach where firms between 50 and 100 billion are really part of the regional banking organization group. Firms 100 billion and above are in the large and foreign banking organization and group. And even within that, there are distinctions between firms at 100 to 250 and 250 and above. And I think part of the problem is that that framework, which really focuses on asset size, is not sensitive to the kinds of problems we saw here with respect to rapid growth and a concentrated business model. That's one of the reasons why, earlier this year I announced that we were going to have a novel supervision group that really focuses on these kinds of issues.
So to that point, do you think, you said yesterday before the Senate that the Federal Reserve has broad authority to apply additional prudential standards to banks with more than 100 billion in assets like Silicon Valley Bank. Is this a situation where the Fed needs different authorities, or has the Fed simply chosen not to use the authorities given by Congress? Like, where should you be jumping in?
We're going to look at our own framework, our own supervision, our own regulation. I think that self-assessment is really a critical part of risk management. As I mentioned earlier, we have a team of staff working on it who are not responsible for supervising SVB. We're going to look at our own structure and suggest reforms.
Give me some, what does it take to get y'all's attention and to put a sense of urgency to situations like this?
I think it's an incredibly urgent situation. When we learned of the immediate distress of the firm, we stepped in and took decisive action to make sure every American's deposits are safe, and we put in place a liquidity measure to make sure that banks all across the country would have the liquidity they need in case any institution were
You're talking about over the weekend, when you found out on a Thursday, you're talking about over the weekend you took these steps. I'm talking about, did you not get these warning signals ahead of time?
Sir, the bank supervisory staff certainly issued those warnings to the bank. The question we're looking at, the review, is why those were not escalated in a more rapid way. I agree with you. We want banks to be paying attention to supervisors, and almost every bank in the country, as you just described, if you get a letter like this, you get a series of problems like this. They had many, many problems. I'm focusing on liquidity and management and interest rate risk, but they had many other problems too. You have a bank like that not responding, that's a real problem.
In your role as regulators, what would you do differently for each of you?
I think I'd start with making sure that we escalate things faster and intervene more promptly with respect to mitigation. But as I said, we've just started this review. I'm going to get a staff review back, and I want to really hear their expert judgment without any preconception about what they're going to come up with.
Did they jump to conclusions on having this as a systemic risk?
Pardon me?
Was it the right decision for the president to issue this, or I guess the board that voted on it, to issue this as or to deem this a systemic risk?
I think it was the correct judgment, sir. It was a very difficult judgment, I know, for everyone, but a unanimous Federal Reserve Board, unanimous board of the FDIC, and the Treasury Secretary agreed after consulting with the president. I think it was the right thing to do for the country. I think it saved a lot of small businesses and households, community banks, regional banks, from a kind of contagion that really could have been quite destabilizing. And we're now in a situation where I can say the banking system is sound and resilient. I think that was really the right thing to do.
What about what's your opinion on raising I get asked questions, the $250,000 insured limit?
Yeah, let me respond, if I may, Congressman. Seems to me that the decision to guarantee the deposits of these two institutions really raises that question up. As I indicated in my testimony, The FDIC is going to undertake a comprehensive review of our deposit insurance system. Certainly one of the things we'll look at and identify different options for consideration is the scope of coverage and whether we should increase coverage overall or for particular
I would like
Vice Chair Barr, when Congress passed the deregulation bill in 2018, is it fair to say that it reduced supervision requirements by the Fed for small and medium-sized banks?
The overall effect of the law was for the smallest banks to reduce regulatory burden, for banks within 50 to 100 billion in range to limit the Federal Reserve's discretion with respect to those institutions. But for institutions over 100 billion, the Federal Reserve retained discretion to do something different. It chose in 2019 to put in place a set of rules that I think had the effect overall of reducing supervision and regulation of such firms.
Chairman Gruenberg, for folks who are concerned about the future of small and medium-sized banks in this country, what assurances can you give them?
Well, Congresswoman, as a general matter, our small and medium-sized banks remain in good condition, including their liquidity. And I think the actions we took did help to stabilize the system. And I think, as I indicated, any expense by the Deposit Insurance Fund to cover uninsured depositors will be imposed through a special assessment on the industry, and we have discretion to tailor that assessment to the institutions that most directly benefited. So we're going to try to be thoughtful in this process.
So I think one of the things that, Mr. Barr, when I was listening to what you said yesterday and today, S2155 isn't the reason that these banks failed. These banks were over $100 billion in assets, and therefore it's just a red herring. Isn't that accurate?
What I would say is that the Federal Reserve's rules issued in the wake of 2019, in the wake of the legislation that were issued in 2019, they did have the effect of lowering supervisory and regulatory standards for firms, but the Federal Reserve retains the discretion to have different rules. And one of the things that I think would be my job going forward is to put in place rules that are appropriate for that size institution. We have the discretion to do that.
So over the past year and a half, we've seen a substantial increase in the federal funds rate. And during that span, are you aware if the Fed or other prudential regulators had conversations, not specific to Silicon Valley Bank, about the inevitable interest rate risk that presents?
Yes, that is a core topic in supervision. Supervisors were very focused on interest rate risk. It was an important part of what we highlighted in our fall supervision report. Examiners were given, beginning this year, beginning last year, extra training on interest rate risk. So it is just a bread and butter supervisory issue. It's not some esoteric problem.
So in that sense, did Silicon Valley Bank's failure surprise you?
Its failure did surprise me. Its risk-taking was excessive, but even then, I did not anticipate, I don't think anybody anticipated, that they'd have a devastating bank run that basically wiped out, $42 billion on Thursday afternoon, another $100 billion expected the next day. That would be 85% of its deposit base in a 24-hour period. That was shocking.
Well, I submit that the hold to maturity spread has to be considered, not just the available for sale risk because of the need for liquidity. Is that something that you're focused on as you conduct your review?
Yes, I think you're absolutely right that we need to look at both sides of the balance sheet. We need to look at the liability structure and the asset structure, and the whole point is to assess whether under certain conditions you can have more stress on the liability side that forces you to sell on the asset side. Those are interrelated.
Mr. Gruenberg, do you share that concern about how we're looking at systemic risk?
Yes, I do, Congressman.
Mr. Barr, on March 9th, you gave a speech that touched on stablecoins and brought up specific risks associated with stablecoins. In that speech, you stated, quote, this mismatch in value and liquidity is the recipe for a classic bank run. Stablecoin issuers are not supervised by the Fed and lack capital and liquidity as a backstop. The banks we regulate, in contrast, are well protected from bank runs through a robust array of supervisory requirements. Would you revise those comments if you could?
Yes, I think that, you know, it demonstrates the need for humility in thinking about how financial risk happens in the system. That's been a theme of basically all of my academic work on systemic risk is we need humility, and that's why you need really strict capital and liquidity rules because of exactly the kind of circumstance we just saw.
Silicon Valley Bank, which I feel like no one's focusing more on them as the bad actor here, and the mismanagement and the inappropriate actions. You know, you kept saying over and over again that they weren't responding. If you had, you know, we should have done something when we knew they weren't responding. I mean, what could have been done?
It's an excellent point. I mean, I agree with you. You start with the basic problem that the bank managers mismanaged the bank.
Did they hide something from us? What did they hid all this from us? Do you believe they hid this intentionally from the feds?
I don't have access yet to the full supervisory record.
Will
to
you
be
let
able to
us know?
answer
Because
your
I really
question.
do think they misled and probably lied and made some inappropriate and fraudulent probably actions that I hope that we'll hold them accountable to.
We will definitely be looking into that, and we retain enforcement authority to go after people who, at the bank, who violated the law or who breached their fiduciary duty or who engaged in unsafe and unsound practices, and we will hold them accountable
Yeah, and
to the
Chairman
full
Gruber,
extent.
let's not negotiate with bad actors like that. We think this is the time to really hold them accountable, honestly. This is how we set a precedent. But going back to you, Vice Chair Barr, bonuses were paid out when? When was the last bonus paid out before they
As I said, I'm still getting access to the supervisory
We know it was a
record.
couple hours before, correct?
I've heard news reports about that, but I want to make
So
sure
you don't
that
even
I
know
get
when the
full-
bonuses were paid out? You don't have that information for this committee right now?
I do not have that information
Was
right
it the
now.
day of?
I would like to respond to you fully and accurately, and I want to be careful to do that properly. I've heard news reports about the timing, but I don't
How
have
come
the
the
full...
news knows, but we don't?
Pardon me?
How come the media and the news know, but we don't? How do you not know this before our financial service? Because this is important.
I agree with... I share your outrage about it. I just want to make sure we get to the facts.
Do you even know how much the bonuses were?
As I said, I think you're hitting at exactly the right issues. We're going to use our enforcement authority to the fullest extent possible.
Well, now, you know, everyone's saying, oh, we're going to go ahead and introduce some clawback legislation to see. But, you know, Chairman Gruber, I asked the Fed Chair Powell about this. You know Section 956. It's been, what, 12, 13 years? When are we going to have a rulemaking on that? This is about excessive pay. This is about, I mean, this is something that Congress already considered. So how come it's over a decade that we don't have anything rulemaking? In 2016, there was a proposal. It wasn't great, but it was a really great start. It would have been instrumental here.
Yeah, no, I'm familiar with the rulemaking, Congresswoman. I was strongly supportive of it. We didn't complete it in time.
Why?
Well, I think there was a change of administrations, and that may have had something to do with it. Every reason to come back to it now and complete that rulemaking, and I
If
think
you had it today, what could you have done in this instance?
it would have
Because
given us-
I'm tired of us being asked to pass things when I
would
feel
have-
like we already did, but
would
it's
have
over
given-
12 years that we don't actually have something again that we could have used as a tool.
It just answered, it would have given us explicit clawback authority on compensation. As I pointed out earlier, we do have, in fact, a legal obligation, the FDIC, to investigate the board and management of failed institutions and hold them accountable for any misconduct that might have occurred.
Yeah, public advocates really believe this could have maybe prevented this.
And so we'll...
Primarily because, as you guys know, that there's some inappropriate decisions made up so they can do the bonuses
and that's
and the payouts.
And that's what we're going
It
to...
is clear as day, and I don't know why my colleagues are not even talking about that.
As
They're
I've-
talking about you all not getting things that, well, they didn't respond. How come nobody's mad at the bank for not responding?
All I can tell you, we've initiated the investigations to get the facts, to take action in regard,
Chairman-
assuming the facts support the
Chairman Grunberg,
allegation.
Vice Chair Barr, what data over that time period drove you to go beyond the SVB and Signature, which was made aware, I guess, on Sunday? And did you think that if you were to protect an idiosyncratic bank, such as SVB, you would need to protect all? What data drove you to imply that all bank deposits would be secured?
The decisions that we made that weekend were obviously in a very compressed period of time. They involved not only gathering information about what's going on in the economy, but also the exercise of judgment. It was our judgment collectively on the Federal Reserve Board, unanimous decision of the FDIC and the Treasury Secretary, that we needed to do that to protect contagion from infecting healthy banks in the system, community banks, regional banks around the country. It is a judgment call. It was based on the information we had at the time. I think it was the correct decision.
I don't want to prolong it, but so there was actual data from other banks that they could be in jeopardy from
we were
systematic
learning,
problem.
I'm sorry, I didn't mean to
It
cut
being
you
a
off.
systematic problem as opposed to a unique problem?
As I said, it's a human judgment, but the information we were getting from other regional banks suggested pressure that was building.
Will FDIC rates go up on community and regional banks? And aren't banks taxpayers too?
Oh, they certainly are, Congressman. As I've explained previously, just to be clear, the action covered uninsured depositors at those two institutions. And the FDIC is required by law that any loss to the deposit insurance fund as a result of those uninsured deposits has to be paid for by a special assessment on the banking industry. And we have authority under the law to consider the types of entities that benefit from any action taken or assistance. So we have discretion in designing the implementation of the assessment.
Okay.
And as I indicated previously, we're keenly sensitive to the potential impact on community banks.
Well, good. The November 21st, there are reports that the Fed, on November 21st of 2022, there's a report that the Fed was aware of the balance sheet issues of SVB. Why wasn't there more enforcement taking place?
We were aware and focused at the supervisory level of interest rate risk in the firm and liquidity risk of the firm. I don't think the supervisors expected, I don't think anybody expected a devastating bank run of the kind I described before, with 85% of deposits fleeing or expected to flee in a 24-hour period.
So Vice Chair Barr, should a bank with an unstable, uninsured deposit base like SVB be subject to a higher standard of regulation than a bank with a stable, insured deposit base?
Representative Torres, I couldn't have said it better myself. I think you described the situation exactly correctly. And the unique...
Flattery will win you no points, but sure.
It's just the truth. I wish I had said it that way. But no, I think there are unique risks to this kind of heavy uninsured deposit base. And for most banks in the country, as you described, they handle their interest rate risk properly. They have stable deposits. I know all of you, when you talk to your banks and you go back home across the country, they're doing okay.
But you agree that the rigor of regulation should depend not only on size, but on deposit stability, yes?
I do.
Chair Gruenberg, to what extent do you worry about the office loan portfolio representing a ticking time bomb in the banking system?
It presents a risk. It's one the FDIC has talked about and identified publicly.
And Signature was the largest commercial real estate lender in New York City. How much of Signature's commercial real estate portfolio consists of office real estate?
That's a good question. Let me get you the exact note. It's a substantial portion of
Can you get me back an answer in writing?
I can get that.
As you go through the process of seeking a buyer for Signature's residential real estate debt, to what extent will you seek the input of New York State and New York City housing officials who have an obvious stake in preserving the affordability of these properties and units? And to what extent will you prioritize affordable housing preservation in your selection of a purchaser?
Thank you, Congressman. Just to be clear, we have sold Signature to New York Community Bank.
You sold everything but the real estate portfolio, as I understand. That's been publicly reported.
I take your point. No, we'll be glad to work with you and other local officials in New York in regard to the disposition.
I appreciate that commitment.
Sure.
I'm not advocating the following course of action, but I want to provide you with a hypothetical. The banking system is reportedly sitting on more than $600 billion in unrealized losses from securities, and those losses will only rise with rising interest rates. Since the problem with these assets is one of asset duration rather than asset quality, should the Federal Reserve consider purchasing these securities? Unlike a bank, which needs liquidity to honor obligations to depositors, the Federal Reserve has the ability to hold these assets to a maturity without realizing those unrealized losses. Wouldn't that solve the problem?
You raise an excellent point. Under existing law, we cannot do asset purchases. But what we do is provide ample liquidity to the financial system on the basis of those
But the
assets.
losses remain, even with the emergency liquidity, the losses remain on the balance sheet. Those losses are arguably undercutting public confidence in the banking system. And as you know, banking is as much about psychology as it is about finance. Why not just remove the losses?
I'd go back to the first point you made in your earlier question, which is that for most banks, they're managing this well. They're doing fine. They have stable deposits, and they don't need to sell the assets they have on their balance sheet. Those assets can stay there and be held to maturity. If institutions need liquidity, they can get access to that from the discount window, and from the program we established, the Bank Term Funding Program gives longer-term stability at par for those very assets.
I want to squeeze in one more question. Did the bank supervisor at the San Francisco Fed have the supervisory authority to prevent Silicon Valley Bank from investing in unhedged long-term securities? Did you have that authority? Like, is the problem a lack of authority or a failure to exercise the authority you had?
The bank examiners cited them for not behaving properly with respect.
But did they?
I guess I want to start with Undersecretary Liang. Is this a problem? I mean, we invoke the systemic risk exception and cover both insured and uninsured depositors. Is it not creating more systemic risk in the overall system because capitalism is no longer a thing? The government's backstopping everything? Is that a concern?
In this case, the systemic risk exception was taken. Depositors, all depositors were covered. Shareholders and debt holders were not. They lost their investment. Those who took the risk lost their investments in this case. I do think this situation, the actions were taken to prevent contagion to spreading to other banks. It was to help safe banks, small and other regionals, who were losing their deposits to either the largest banks or to outside the banking system. I do think this requires that we will need to be assessing and looking for reform.
So I just want to quickly ask each one of you just a yes or no. Do you think this is a crisis, Mr. Barr?
As I said at the outset, I think our system is sound and resilient.
Is it a crisis or a yes or no?
I think that it was appropriate use of the systemic risk exception to prevent a crisis.
Is it a crisis, yes or no?
As I said, I think that where we are now, the banking system is sound and resilient. There was risk that if we did not invoke the systemic risk exception,
But you have used the word
it could have led-
crisis, is the question.
I have not used that word.
Okay. Chairman Greenberg?
I think we were at risk of crisis, and I think the actions that we took have stabilized the system.
Ms. Yang?
I agree with that. The actions we took stabilized the system.
Vice Chair Bart, yes or no again. Do you believe that ESG investing played any role in the failure of Silicon Valley Bank?
No.
Mr. Greenberg?
No.
Ms. Liang?
I do not have the information that the supervisors have, but I would, my strong preference would be no.
Vice Chair Barr, will you remind us what researchers at the Fed have concluded about attempts to blame the housing and foreclosure crisis on historically disadvantaged communities of color?
The research showed that there is no basis for the conclusion that low-income, moderate-income consumers, households, were responsible for causing the financial crisis.
Okay. Do you think that the communities of color, the disadvantaged communities, and particularly people in my district that is 77% Latino, should be concerned that this bank failures and some of the remedies that are being put in place may cause a lack of capital, the lack of opportunities to be able to buy homes? Will it impact mortgage rates?
I think the steps that we took together to stabilize the economy and provide public confidence in the banking system are of assistance to low and moderate income households and to all Americans around the country.
But do you think there will be some negative impact on interest rates and the ability to borrow, to buy and purchase homes?
My estimate is that the bank's reaction to the current economic circumstances are likely to lead to a reduction in credit availability overall. That's something that we're watching very carefully at the Federal Reserve.
What role did crypto play in all this?
I don't believe crypto played a direct role in either of the failures. So that, yeah.
Was there an indirect role?
I know that Signature had activities involved in digital assets, but I don't believe that is the main.
The gentlewoman's time. Can you describe the condition of Signature Bank at the time of its receivership and what evidence you had that showed Signature was also facing a liquidity crunch on March 10th? And what was Signature's available funding at the time New York State DFS closed the bank and placed it at FDIC receivership?
Congressman, we can get you the specific data, but the fact is that on Friday night, that bank had real difficulty meeting its obligations at the end of the day and barely met them by the 5:30 closing time. And I think both New York State and the FDIC, who jointly had responsibility, did not think that the bank could open and make it through the day on Monday. I think that was the determination. And that's why New York State on Sunday decided to close the institution.
All right, and you can get me the specific numbers.
Yes, we can.
Thank you. It was reported early yesterday evening that the FDIC sent a notice to depositors whose deposits were not included in NYCB's bid, informing them that any accounts not closed by April 5th will be automatically shut and depositors will receive a check in the mail. Can you walk me through FDIC's reasoning for this decision?
Yes, Congressman. So the winning bid for Signature by New York Community Bank's subsidiary, Flagstar, was for all the deposits except the winning bid chose not to bid on the digital assets. And there were about $4 billion of those. And we provided those depositors a couple of weeks to determine what they might want to do. And we sent them a notice that we'll return their deposits to them by early next week, I believe. So just so I'm clear, the digital deposits are being returned to their deposit holders. It's my understanding that Signet was not acquired and remained in the receivership and is in the process now of being marketed.
So Signet is still under FDIC
yes,
receivership?
It's in the process.
Thank you very much. Chairman Grunberg, I also want to bring this up. In the Senate banking hearing yesterday, there was an exchange between Senator Van Hollen and Vice Chair Barr on the guidance on guidance issued in 2018 and codified in 2021 when Randy Quarles was Vice Chair of the Supervision of the Federal Reserve Board of Governors. I recently read an op-ed in the Wall Street Journal written by Randy Quarles, which has said that both you and Lael Brainerd voted for this guidance. Is that true? Did you vote for this guidance?
Yes, we did, Congressman.
Chair Grunberg, as we consider different deposit insurance reforms, should we seek to maintain risk-priced deposit insurance?
Well, I think we do want to maintain risk-price deposit insurance, but I do think, you change one part of the system, it impacts another part of the system. So, as I indicated earlier, the FDIC is undertaking a comprehensive review of the deposit insurance system in light of this episode, and will release a report by May 1, also laying out policy considerations for changes to the system that we hope will inform the discussion around this.
So beyond the report, moving forward, what steps can the FDIC take when making decisions about deposit insurance assessments to make banks think twice about various financial stability threats that disproportionately impact marginalized communities?
Well, we have authority now to do risk-based pricing, and I think it's fair to say that in light of this experience, we need to think hard about liquidity risk and concentrations of uninsured deposits and how that's evaluated in terms of deposit insurance assessments. But I also think it's an appropriate moment to take a look at how our system works in light of of this episode, and consider what other changes might be prudent.
Vice Chair Barr, what can Congress do to strengthen and support community and minority-owned banks in situations like we just experienced?
I agree with you that having a wide diversity of kinds of institutions in our country is really critical, including community banks and regional banks, minority depository institutions, and community development banks. All of these institutions, I think, are really important for economic vibrancy and inclusion in our society. We'd be happy to work with you on ways that we can continue to support those institutions going forward.
And Chair Gruenberg, I would love to hear from you what kind of deposit insurance reforms would help support minority depository institutions and other community banks.
It's an interesting question. You know, we're in the process of finalizing a major revision of the Community Reinvestment Act. And in the proposed rulemaking, there were specific provisions to encourage banks to work with and support minority depository institutions and community development financial institutions. So I think that's actually an important vehicle and opportunity to strengthen our MDIs and CDFIs, which serve LMI communities. And it's an interesting, we should give some thought in our review how deposit insurance may play into this as well.
Vice Chair Barr, did you originally believe that inflation was temporary and transitory? Yes or no?
I was not on the Federal Reserve Board at that time.
Did you believe it was temporary and transitory, or you had no opinion?
I would say at that time I did not have an informed opinion.
Would the challenges that we saw with SVB have taken place if inflation truly was temporary and transitory? Yes or no?
The problems that came about from SVB are from classic interest rate risk management.
So if inflation was temporary and transitory, then I will make the assumption on your behalf for myself that interest rates would not have gone up. If interest rates didn't go up in the manner and hold in the way that they are, SVB would not have occurred. The breakdown of the bank.
Sir, banks have an obligation to manage interest rates, whether they're going up or going down. It's just classic good banking, and it wasn't done here.
You noted that there was a challenge in the model that it was, quote, was not at all aligned with reality, end quote. Was that a challenge in modeling in particular interest rates? Or what part of reality was it not connected with?
Basically, what I meant is that their model showed that they'd earn more money as rates were going up, and they were losing more money.
So interest rates was at the core of how it was disconnected from reality?
Yes, it was about interest rates.
That's fair. So the Federal Reserve is taking collateral from the FDIC and loaning the FDIC money. Under what statutory authority is the Federal Reserve engaged in that?
Sir, the Federal Reserve is lending through the discount window to the bridge institutions that were established by the FDIC. So they're lending to banks. There's a provision in the statute that clearly contemplates that.
And so you're noting that when I read footnote 7, that would not have fallen under the line of either primary credit or secondary credit?
For the purposes of enhancing transparency to the public, that line was broken out so that everybody could see exactly what it was.
Okay, that is helpful. Then if I can shift to you, Chair Gruenberg, as we look at this dramatic increase, is there a reason that you used this facility rather than one, selling assets, or two, tapping your line of credit at the Treasury, which I believe is to the tune of $100 billion?
We certainly have sold assets to meet our liquidity needs. And these bridge institutions are nationally chartered banks eligible to borrow from the Fed and utilize that in order to manage the liquidity situation as well.
But is there a reason that you're not either A, utilizing in a more substantive way the credit line available from the Treasury, or B, selling assets? And the reason I ask this, so maybe I can be more specific, does the FDIC have this same risk that we're seeing in other banks with unrealized gain or unrealized losses? And is that why you're tapping this facility rather than selling assets?
No, Congressman, we are selling assets to meet the obligations of the failed institution, and we're also managing the liquidity. These bridge banks have the authority and ability to access the Fed resources.
So you're both selling assets and borrowing from the Fed to the tune of $178 billion at the same time?
for these institutions to meet immediate liquidity demands, which we'll eventually get back.
And did the Treasury at any time discourage you from taking a loan from the line of credit from the Treasury for purposes of addressing the debt ceiling limit?
I think there were discussions in regard to that, but I think the principal purpose here, frankly, was liquidity management and also to be able to preserve liquidity in our deposit insurance fund.
So, Vice Chair Barr, in just a few months, the United States Congress needs to raise the debt ceiling. If the U.S. defaulted on the debt, would it be really bad for our economy?
The basic answer to that question is that Congress needs to increase the debt ceiling, that there's not other options around that. In the absence of an increase in the debt ceiling, it could cause enormous dislocation to our economy. I wouldn't characterize it. I think that it's the right thing to do. I think Congress needs to do that, and really leave anything else about the debt ceiling up to discussions between the administration and Congress. Just to say, from an economic perspective, it would be quite unfortunate.
Thank you. Vice Chair Barr, the second largest banking failure in the United States history, $42 billion pulled in a day. Who was asleep at the wheel?
I think in the first instance, as I've said, bank management is responsible for running the bank. They failed in basic measures of interest rate risk and liquidity risk. They had very many outstanding matters requiring attention, matter requires immediate attention. They were deficient in governance and controls. They were rated a 3 overall with respect to the firm, which means they were not well managed. And at the end of the day, it's the job of the bank and their board of directors to run themselves the way they should. We, of course, are looking internally at our own supervision and our regulation in looking at ways that we could have forced the firm to do more faster or raise standards so that if the firm got into trouble, they had more capital and liquidity.
Chair Gruenberg, moving to you now. First Citizens Bank, which is located in my congressional district, North Carolina's 13th district, was the successful bidder for Silicon Valley Bank. Can you tell us about the evaluation process for the bids that were submitted and what made First Citizens the most attractive bidder?
Two reasons, I'd say, Congressman. One, financially, it was the strongest bid for the FDIC. And two, it was a bid for all the deposits of the institution and all of the loans of the institution, so that it provided operational certainty as well. So from both a financial standpoint and an operational standpoint, it was really the strongest bid we received.
And it took a while. You know, why wasn't Silicon Valley Bank purchased sooner? I think that certainly would have created more stability in this situation.
If we could have sold it that first weekend, that would have been desirable. The fact is, Silicon Valley was a pretty large institution, $200 billion in assets, and pretty complicated in terms of its business activities. So for a potential acquiring institution to do the due diligence over a weekend and reach a conclusion and make what was frankly not practical. And so we set up a bridge institution and for both of the failed banks, and we're able in a pretty orderly way to set up bidding processes for each. In fact, for Silicon Valley, we had considerable interest and got a couple of requests for additional time for interested parties to do due diligence. So we extended the bid date a couple of times to give people time, and we ended up, getting, I think, 27 bids from 18 different sources. So it ended up being a pretty constructive process.
So I want to ask you, who decided to put SVB under the horizontal review process? How did you conclude that the firm did not merit actions beyond the horizontal review process?
Thank you, Representative Kim. I think that's one of the things we're trying to figure out in the review. The supervisors on the ground saw the risk that you described, saw the interest rate risk, and saw the liability risk. They required the firm to make changes. The firm didn't make those changes in time. The concern of supervisors grew. You can see that from the fall of 21 to the deficiency rating in 22, and then further action that year. But you're absolutely right that at the end of the day, the bank failed, and so
Well,
we need to.
so Mr. Barr, I want to ask you, how will you consider tighter credit conditions as part of your holistic capital review and Basel III endgame reforms?
So we're looking to review our capital requirements not for the current situation, but for the long term. Any capital requirements that we consider would go through notice and comment rulemaking and have a transition period, so they would not apply to the current economic circumstances that we're in. We're thinking about the long-term effects. We are, of course, paying attention to tightening credit conditions as part of our monetary policy decisions. Those factor into our forecast for the economy and therefore into our interest rate decisions.
Can you tell us why FDIC board decided to deny the first bid? And did you see the second bid as more expensive than the $20 billion incurred by the insurance fund?
Well, I think the point is that neither bid was less expensive than liquidation. So liquidation would have been a less costly alternative than either acquisition at that point. And frankly, the limited bids and the quality of the bids we received was a function of the very compressed time frame, because we just taken over the institution Friday morning, and this was Sunday afternoon, and we thought it was in the interest of the Deposit Insurance Fund to place the institution into a bridge so that we could manage it for a brief period of time and then organize an open bidding process so that interested parties would have a fair opportunity to bid on the institution. And that's ultimately what happened. And if it would be helpful, I'd be glad to respond in writing. I know
that would be fair. And so, Mr. Grunberg, knowing that this panic occurred through social media, in response to the suggestion that not all depositors would be protected when the FDIC took over SVB, what lessons can regulators take from this to improve their public communication when a future bank fails, and knowing how quickly depositors can immediately move their money in this new technological age? And specifically, I know you're going to take time, and we'll hear a lot more about this in the future, but what do you think is needed to expedite the responses necessary to mitigate something like this from happening again?
Well, to prevent it from happening again really raises all the supervisory and regulatory issues we've been talking about this morning. I do think in regard to deposit insurance, we should do more and perhaps a better job of explaining to the public how deposit insurance works, what is covered, what is not covered, what are the options available to people when they open a bank account. And I think that would also be one of the reasons to undertake this overall review of the deposit insurance system to see what changes might be considered that would be helpful to the public.
And so what message do you have for them, for our constituents and small businesses, to reassure them that our financial system is stable and that their money is secure?
Well, I think that's an excellent point. I know when many of you talk to banks, you know, in your own in districts, they're telling you the same thing, which is that banks are sound and resilient. I think if you look at the actions we took a couple and a half weeks ago, those actions demonstrate that we're committed to ensuring that all deposits are safe. We're prepared to use those tools for any size institution as needed, if appropriate, to keep the system safe and sound. So the basic message is that the banking system is sound and resilient.
You were confirmed July 19th, 2022. So you came in kind of in the middle, according to your own testimony, of when the San Francisco Fed was having examinatory issues at SVB. Is that fair?
The examiner report with respect to the whole firm as a whole was done in July 2022, and that's when I arrived.
Is it your assessment that there are serious supervisory issues at the San Francisco Fed?
We're doing the review of that now, and I don't want to prejudge the outcome of it. There were clearly supervisory...
Well, Mr. Barr, it is a rational judgment that if all these supervisory findings were existing for the last 2 years, and this still resulted that there are supervisory issues at the San Francisco Fed.
I don't want to assume. I want to go look at the facts. We're going to go look at the facts in this review. I think that overall, at the Federal Reserve, without pointing any fingers in any direction, that there were significant supervisory failings. I said that at the outset of the hearing, that if you have a bank like this that's failing, there are serious management issues, there are supervisory failings, there are regulatory failings, and we're committed to looking at all of those.
And that's fair. Former president of the Federal Reserve Bank of Kansas City, former vice chairman of the FDIC, and he says if they go high enough, you can actually be losing money on those assets. He was concerned about rising interest rates on bank portfolios writ large. Do you agree with that statement?
Yes, I think interest rate risk, again, is a core risk. We look at it across the system, and banks are supervised for that. It is absolutely essential they manage that risk.
Mr. Barr, let me ask you a question. Do you think that this committee should be talking to SF Fed President Mary Daly?
I think, the committee's decisions about witnesses is far outside my expertise.
You have a speech dated March 9th, 2023 at the Peterson Institute for International Economics here in DC. In your speech, you say, the banks we regulate in contrast to stable coins and crypto markets, are well protected from bank runs through a robust array of supervisory requirements. You still stand by that statement?
I think that it demonstrates the need for humility about our ability to understand the causes and consequences of financial difficulties. So, of course, that statement in this context is turned out to be incorrect.
So, Chairman Grunberg, how would an increase in the FDIC insurance limit prevent further consolidation of deposits at the largest banks?
Well, I think, Congressman, I think that question is raised by this episode. The decision to guarantee the uninsured deposits of these two institutions really have implications for the entire deposit insurance system, and we need to consider it. And I'd like to do it comprehensively, looking at all the aspects of our deposit insurance regime, and then come back by May 1 with a report that the FDIC will put out, which will also provide some policy options for consideration.
So, Vice Chair Barr, I would really urge you to consider the effects of increased capital requirements on the lending of healthy community banks. However, I do believe that action must be taken. So, would you be able to discuss any additional strategies the Fed would be able to pursue to address the problems that we have seen at Silicon Valley and Signature banks without reducing credit industry-wide?
Thank you very much. First of all, the capital review that we're doing does not apply to community banks. We're not intending to increase capital requirements on community banks. My understanding from looking at the community banking system is that it is well capitalized and stable and is serving its communities. We are looking at larger institutions. If we do that, we're going to do it through a notice and comment rulemaking process. That takes a good bit of time, and there are transition rules. So we're not talking about capital rules that in any way that would apply now. We're talking about how to make sure that the capital and liquidity rules in the future are appropriate.
Reports that after Silicon Valley went into receivership, they literally advertised that their FDIC guarantee as a way to attract depositors. Is that true? And if so, what's being done?
We placed Silicon Valley into a bridge institution. There may have been some communications of the kind you described. When we heard about it, we put an end to it.
Vice Chair Barr, you testified that the Federal Reserve examiners cited Silicon Valley Bank 7 separate times, and you testified that examiners were aware of Silicon Valley Bank's interest rate risk last year. Why wasn't that risk reflected in Silicon Valley Bank's liquidity rating?
One of the things we're looking at the review is, given the extent of difficulties, the problems the firm was having, how did the regulators come up with this particular, the supervisors come up with this particular approach? Its composite rating was not well managed, and its holding company rating was deficient, that is also not well managed. But it has a 2 for liquidity and it conditionally meets expectations for liquidity. And so we're trying to understand how that is consistent with the other material. I mentioned earlier, too, that I'm highlighting the liquidity and governance and interest rate risk findings, but there were many other findings at the firm that had not been addressed at the time they failed. And so the question is, why wasn't that escalated and why wasn't further action taken?
Was that composite score, that composite CAMELS rating, ever downgraded in 2021 following the examiner's citations?
I don't know the answer to what happened in 2021. The 2022 rating was the first time the firm had a composite rating for all of its activities as it entered the large and foreign banking organization group.
Vice Chair Barr, was Silicon Valley Bank's liquidity rating ever downgraded following the examiner's citations in 2022, or is that the same issue as you just described with the large bank status, their liquidity rating?
The overall rating for the firm, of which this would be a part, was done that summer. There was a process after that of looking at both liquidity risk and interest rate risk. And my understanding is part of the horizontal review that was being conducted at the beginning of 2023, the examiners were looking at, what was the appropriate level.
Given the several supervisory findings identifying various issues with Silicon Valley Bank's practices since 2021, were those findings communicated to the FDIC?
I can tell you, Congressman, that the criteria to get on the problem bank list is to be rated a 4 or 5 on the CAMELS rating scale of 1 to 5. And at that time, Silicon Valley was not rated a 4 or 5, so we wouldn't have been in a position to put it on the problem bank list.
Vice Chairman Barr, why wasn't this information shared for the purposes of the FDIC's problem bank list?
As Chairman Grumman just indicated, the FDIC makes an independent judgment with respect to its list based on the ratings of the firm, and the firm was not rated lower than a 3.
Chairman Gruenberg, has Silicon Valley Bank ever previously been on the FDIC's list of problem banks?
The reason I hesitate is we put the aggregate assets of the institutions on the problem list. We don't indicate the individual institutions.
Here you can do that.
No, I take your point.
And this is a question from Congress.
Yeah, well, I believe I can come back and answer your question if I may.
Yeah.
Could we follow up for the record? But be glad to do that. I just want to check, but yes, the answer is we'll come back with an answer.
The answer is yes?
We will come back with an answer for you if that's okay.
Vice Chair Barr, as part of your internal review, you've indicated that you plan to evaluate whether the application of more stringent standards would have prompted SVB to better manage risks. So as part of that, do you expect to look into whether more frequent stress testing for a bank of SVB's size would be appropriate?
Yes, Representative Meeks, we'll look at stress testing. We'll look at really all the enhanced prudential standards, liquidity standards, capital standards, stress testing. All of that will be part of our review with respect to SVB, and it'll help inform broader questions we've been working on since I arrived in July about what the capital framework for the system should look like.
Now, are stress test results for our largest banks, those that are above $250 billion, they are available to the public? Is that not correct?
Yes, the stress testing results are available annually to the public.
When a bank with about $100 billion in asset size is subject to stress testing, who has access to those results? Would, for example, an individual or small business client of the bank be able to see those results?
So under the current framework you correctly described, the Federal Reserve's rules established in 2019 would provide that SVB would be subject for the first time to stress testing in 2024. There is currently, under that structure that was put in place in 2019, no stress testing for firms below the 100 billion level, and that's part of the framework.
So could you expound a little bit more on how helpful it might be for a depositor, for example, to get to see those results, especially depositors who are uninsured, that have uninsured deposits?
So stress testing results for the firms that are in stress testing are published annually. For firms that are below that level in the current framework, they're not required for that kind of stress test. They do internal liquidity stress test as a normal part of their requirements on a quarterly basis. That's an internal proprietary action by them, subject to supervisory review. In the case of SBB, they conducted their liquidity stress test, but the supervisors found that those stress tests essentially were not stressful enough. They were not realistic.
Do you think that, and I don't know, but that there should be some, when you look at depository insurance, a difference between small businesses and personal, as far as that's concerned going forward?
Congressman, that's a good question, and it's one of the things we'll be looking at in the report that we're going to submit on May 1 and laying out some policy considerations to take into account here.
Thank you, Chairman. Chairman Grunberg, just to follow up on that line of questioning, yes or no, should the FDIC insurance limit be raised?
Let us do the work on this and then come back to you with a report.
Well, do you think it should be raised?
I don't know the answer to that question right now, Congressman.
Okay. Did the Fed, the FDIC, and the Treasury have the tools needed to deal with this crisis when you were made aware of the situation with SVB? Do you all believe, yes or no, that you had the tools needed to deal with this?
Yes, we have the tools we need.
Yes?
I agree, yes.
Yes?
I agree, we had the tools to
Okay.
prevent a
Did the Fed, the FDIC, and the Treasury have the tools needed to prevent it? Yes or no?
I think that's a very difficult question to answer. I don't have a yes or no answer for it. I think we can do better at supervision and regulation, but whether we could have prevented the collapse in 24 hours of this institution, I don't know the answer to that.
I agree with Michael's point, but from a supervisory basis, I think there was an opportunity.
I'm sorry, Congressman, can you repeat your question?
Yes or no, do you think the Treasury had the tools needed to prevent this from happening?
The Treasury had the tools to use the systemic risk exception
And used it?
and recommendation to prevent a crisis.
Do you think the Federal Reserve failed here in its role?
I think fundamentally, as I've said, it's the responsibility of bank management to run the bank. The bank managers failed in basic risk management.
Right, but you provided, the Federal Reserve and the San Francisco Fed provided guidance, provided notices, and failed to follow up on that, correct?
I would say that there was follow-up. The question is whether the follow-up was stringent enough, and that's part of the review we're looking at.
But stringent enough really means that the individual people may or may not have done the job that they were supposed to do, correct? Because if you give the notice and you reach out, isn't it incumbent on the individual supervisors to actually follow up and make sure that the bank is doing what it needs to do?
It's incumbent on the bank to take the actions that the supervisors are directing them to take, and it's incumbent on the supervisors to check on that.
Did the supervisors fail to check on that?
No, I didn't say that. What I said is that it's incumbent on the supervisors to do that. I think it's a legitimate...
Did they do that?
I think it's a legitimate and fair question to ask whether they were stringent enough, whether they used enough tools to force the bank managers to do what was obviously right.
With respect, did they do the job they were supposed to do? Did they follow up?
The reason I'm having difficulty answering the question is that I believe they did follow up, but the bank managers did not perform on the job, and that's why we're looking...
Were California and New York regulators equipped with the appropriate tools to handle this? Or should these banks, specifically SVB, given their size, been federally chartered instead of state chartered?
I think that our country benefits from having a wide diversity of kinds and sizes of institutions and the diversity of chartering authorities that we have, so I'm not recommending that we change that.
Okay. When did any of you first speak with Superintendent Harris regarding Signature Bank? Just date, please.
I'd want to check the record on that. If I may, I will come back to you. I just want to be sure we're accurate.
Okay. Do either of you know when you first spoke to Superintendent Harris?
I do not. I mean, Signature Bank is an FDIC in New York state-regulated institution, but I don't know when I first had a conversation about it.
Okay. Chairman Grunberg, when was the decision made to close Signature Bank, and what criteria were used to determine whether or not Signature Bank met the systemic risk exception?
Those are two questions, Congressman. The decision to close the bank is the authority for the state, and the state made that decision on Sunday. And what was the question in regard to the systemic risk exception?
What criteria was used to determine that?
Oh, I think we had before us a failure of two institutions, both Silicon Valley and Signature, and we also had before us evidence of significant liquidity stress at other institutions, and we had data in terms of deposit outflows, and I think that was basically the data we relied on.
Do you believe that, as most Americans do, as I've said and as the President said, that taxpayers should not be on the hook for that? Would you agree with that statement?
Yes.
Further, would you agree with the statement that we should have diversity within our banking system?
Yes.
I agree.
Specifically, then, would you be supporting our regional banks, our small local banks, and recognize the undue burden that they potentially are going to be saddled with as a result of a FDI assessment because of these two banks?
As you may know, Congressman, I responded to that issue, and the answer is the FDIC has authority under the law to consider who benefits from the assistance provided, and we'll take that into account with particular attention and sensitivity to the impact on community banks.
I appreciate that, Mr. Gutenberg. I want to specifically talk to Mr. Barr here. For the diversity in banks, when you do your holistic capital review of banks under $10 billion, what would that look like?
We're not anticipating in any way raising capital requirements with respect to community banks. It's not part of my holistic review.
Special assessments will inevitably have to be part of this. Do you see that being passed along to the top banks primarily, or how will you calibrate that?
Well, Congressman, it's relevant to my response before. We're required by law to pay for any cost to the Deposit Insurance Fund caused by the coverage of the uninsured deposits through a special assessment. We have to do that by notice and public notice and rulemaking, and we have authority under the law to consider the types of entities that benefit from any action taken or assistance provided.
So I understand that, but I just want to highlight the difference here. We had two banks that had 90% of their depositors uninsured at any level, and most banks across America are at 47%. My state of Iowa, in Des Moines alone, it's 70%. And my rural guys, it's 7%. I mean, these are farmers who are looking to plant this spring who know that they have a good deposit there. It's small businesses that are supported by this. What they don't need is ultimately, to my original question, an increase on their cost of living, on their cost of doing business by a special assessment that disproportionately punishes those who are at the medium and small size. Are you committed to making sure that's a priority for you?
Yes.
Silicon Valley Bank did not have a chief risk officer, Mr. Barr, for how many months?
I believe it was approximately 8 months.
These four members were actually on their risk committee, but had no, as I understand it, actual experience in managing material risk. Were these individuals focused on the wrong thing, and was there no true risk management being taken at Silicon Valley Bank in the lead up to the fail?
I can't speak to the particular individuals. I can say that the supervisors told the board of directors and the bank that the board oversight with respect to risk management was deficient. That was one of the findings that was made in the summer of 2022.
So then, did beginner risk management of interest rate risk and liquidity risk cause this bank to fail, SVB specifically?
Yes, ultimately, they mismanaged their interest rate and their liquidity risk, and their very large percentage of uninsured depositors had a massive and unexpected run. As I said, $42 billion on a Thursday, and expected another $100 billion on Friday, and that was just a devastating run for the institution.
One of SVB's memos from their supervisory credit group claimed they had been working closely with the Fed to inform its agenda priorities, namely fiscal risk to banks from climate change. Were the regulators focused on the wrong risk posed by this administration? Yes or no?
The supervisors were focused overall in the system on interest rate risk, credit risk, cybersecurity risk, traditional risk in the banking system. There are some supervisors who are focused on climate change.
My question is to you, Mr. Barr. You quickly announced your holistic view of Fed regulations and your own Fed special scenario analysis for weather and climate risks.
Those are a few different items. I announced that I was doing a holistic capital review, which was looking at capital in the system, whether it was at appropriate levels. We've been conducting that really since July. There's a separate thing, which is that in the beginning of this year, we piloted for the globally systemically important banks, GSIBs, a pilot of climate scenario analysis to evaluate how they were addressing climate risk in the system. That's separate from basically what most supervisors are doing most of the time, which is highlighted in our November 2022 supervision report, which is looking at interest rate risk, credit risk, liquidity risk in the system.
Now, correct me if I'm wrong, but isn't the role of the vice chair for supervision to focus on bank supervision and regulation? Yes or no?
Yes, that is in fact what I am focused on.
So if that's the case, then were you distracted from the mission of your role, which again is supervision and regulation, and instead focused on climate?
No, I would disagree respectfully with that. The way that we're looking at climate risk is about the risk that climate change might pose to the financial system and to individual banks. It's a very narrow role focused on financial risk, not climate policy more generally. And I think, as I was saying before, we need to be humble about regulators' ability or banks' ability to understand all the risks in front of us. It's prudent to look at long-term risks as well as really obvious and central risks right in front of us, like interest rate risk and liquidity risk.
We've heard discussions today about FSOC, the Federal Stability Oversight Council. Vice Chair Barr, what's the purpose of FSOC?
The FSOC is an entity that brings together regulators from around the financial system, market regulators and bank regulators, to look at risks in the system and to try and coordinate across those agencies.
Right. It's chaired by the Secretary of the Treasury. It includes the Fed, the OCC, CFPB, FDIC, CFTC. In fact, all of our witnesses today take part in those meetings. Do you not? Yes or no?
Yes, each of the three of us participate in FSOC as member agencies.
And the function of FSOC, is it also to identify risk to the financial stability of the United States? Mr. Barr, yes or no?
Yes, that is among its functions.
FSOC now also evaluates climate-related financial risk. Is that right, Mr. Barr?
That predates my time, and we're not in charge of running the FSOC, so I don't know the sequence of events. But
I assume that it is now part of FSOC's charge to monitor and evaluate for systemic risk also?
Yes, that, as I indicated previously, is a core function of FSOC, is to look at risks across the financial system.
Signature Valley Bank was listed on the S&P Global Marketplace as the top U.S. bank by proportion of uninsured deposits at nearly 94%. Only 4 other banks were estimated to be above 80%, including Signature Bank, but none of that was mentioned in your December 16th meeting. Are those factors not important to comprehensive monitoring of the stability of our nation's financial system, Mr. Barr? Let me just ask that question one more time. Are those factors not important to the comprehensive monitoring of the stability of our nation's financial system? The debt ratio, the uninsured ratio, is that not important?
The standard factors we think about in banking, among those factors are interest rate risk and liquidity risk. Those are core issues that we do in the bread and butter supervision every day.
So do you not consider the uninsured ratio as part of a factor of systemic risk?
We look, with respect to microprudential supervision of individual firms, we're looking at their liquidity risk. And one element of their liquidity risk is the extent to which they rely on uninsured deposits. That includes uninsured deposits from financial entities, uninsured deposits from operating businesses, and then their insured deposit base. So it is a core part of what we think about when we think about liquidity risk.
But none of that was discussed in the December meeting.
relative to Signature Bank or Silicon Valley Bank or any system gap?
As I said, the specific request to me in that meeting was to talk about this issue. We obviously talk about broader
Any other
issues all the
issues? Yeah,
time.
I get. Will you commit to providing this committee with unredacted minutes from every FSOC meeting since the March 10th meeting, including closed executive sessions?
Congresswoman, I'm aware of 2 FSOC meetings since these events, March 12th.
Will you
and
commit to
March
providing the
24th.
meeting minutes for the executive sessions?
They were executive sessions, and we do produce minutes, and we will release them.
Mr. Barr, when you look at increasing interest rates, especially in a rapid environment, is that going to create risks when it comes to deposit structure for these, well, really any bank, but certainly as it pertains to small and mid-sized banks?
As interest rates change, whether they go up or down, they create risks for banks, and the expectation is that banks manage those risks, and most banks in the country do manage those risks quite effectively.
Now, the regulatory regime that's in place, do they give specific guidance as it pertains to those risks in a rapidly changing environment?
We do have standard guidelines that are issued to banks about how they conduct their internal liquidity stress tests. Those tests are supposed to be designed to stress stressful environments with significant increases and decreases in interest rates. So they're not directionally guided. They're supposed to test up and down.
Well, as far as some of the guidance that was given specifically to SVB, and I think my colleague from across the aisle said they blew you guys off, what types of guidance or alerts were given to SVB?
So Silicon Valley Bank was required to conduct internal liquidity stress tests on a quarterly basis once it reached a certain size. It conducted those tests, and the guidance back from the supervisors was that the tests were inadequate.
Now, so understanding that you have a bank that grew rapidly in a very short period of time, did you ever request a hearing on SVB of this committee of jurisdiction, understanding that there was potential risk in the market?
Representative, I haven't asked this body for additional authority. I said we were conducting a review of our existing authority to see where we could have done better on supervision and regulation.
My banks receive an assessment from the FDIC, and they decide to blow you guys off. Is there going to be some sort of regulatory action? Are you going to send them a bill? Are you going to enforce that assessment?
Well, Congressman, and this has come up previously, we're required by law to the extent there's losses to the Deposit Insurance Fund as a result of the coverage of uninsured deposits to impose a special assessment on the banking industry. And we're required to do that through a notice and comment rulemaking process. Right. And as I indicated, we also have authority.
So I guess to the heart of the question, though, is would you go to the bank and say, we want our money? Yes or no?
The answer is, if they were subject to the assessment, the answer would be yes. We do have authority to consider the types of entities that benefit from any action taken or assistance provided.
Well, see,
So I would ask either one of you to first comment on, can you instill more confidence that in fact we do know what we're doing and we can react quickly, and if it is multiple banks, that we're going to be in a good place. And then I have one more question after that.
Well, I can say in regard to Signature that they basically ran out of money to meet their obligations, and that was the reason the bank failed. As I indicated earlier, they barely met their obligations at the end of the business day on that Friday, and it was clear to the state regulator, New York State, as well as to us, that they could not open on Monday and get to the end of the day based on the liquidity they had, and that was the reason the bank was closed by the state. And I'll let Vice Chairman Barr speak to Silicon Valley, but it was a pretty straightforward decision and a traditional one.
Similarly, Silicon Valley Bank basically was unable to meet its obligations in the ordinary course of business. They suffered a devastating run, a $42 billion run on Thursday. On Friday, they expected to face a run of $100 billion, and they did not have the collateral sufficient to support discount window letting, and so they were not able to meet their obligations, and they were closed.
Ms. Liang, when were you informed, first of all, that there was a possibility of Silicon Valley Bank defaulting? And was the president made aware of that? How much conversation was happening within the White House? And were there conversations with specific depositors or those that had an interest, like Governor Gavin Newsom in California? And now I further learned that the state makes a decision on actually shutting down the bank. What were those conversations like, and could you characterize them for me?
So I learned, Treasury learned, or I learned, I can speak for myself here, of the issues at Silicon Valley either Wednesday evening or Thursday, after it issued its statement, its earnings report, saying that it had a loss and was going to raise capital. We heard certainly Thursday night of concerns at the institution because of the very, very rapid deposit withdrawals. And then on Friday morning, we learned the California state regulator had closed it, and the FDIC was appointed receiver. We did, that was our situation. Over the day of Friday and Saturday, we heard from many people, institutions, businesses, wondering how they could access their deposits, could they make payroll, and so we were gathering information and consulting regularly with the Federal Reserve and the FDIC. So that by Sunday, we could
Did
make
you
a
speak to
decision.
Governor Newsom at any point?
I did not.
Did anybody at the White House talk to Governor Newsom?
I do not know.